Tucked away in secure industrial parks across North America, Europe, and the Middle East, massive fleets of specialized cargo vans and armored transport trucks idle under heavy surveillance, waiting for secure dispatch. The global high-value asset and physical currency logistics industry, a trillion-dollar secure transport chokehold dominated almost entirely by specialized cash-in-transit, CIT, and high-security courier networks like Loomis, Brinks, and GardaWorld, represents the ultimate physical safety net of global commerce. To the everyday consumer, cash, precious metals, and negotiable instruments move seamlessly between bank branches, retail stores, and ATMs through standard municipal delivery routes. To the corporate asset owner, central bank official, and high-stakes risk manager, a secure logistics network represents an absolute transportation monopoly anchored by armored engineering and armed personnel. Building a dominant secure transport network requires deploying thousands of ballistic-rated armored vehicles, highly trained tactical security teams, and encrypted GPS tracking command centers. Unlike traditional parcel delivery companies like FedEx or UPS that prioritize package volume and speed, secure transport operators manage extreme physical liabilities where a single security breach can result in tens of millions of dollars in catastrophic loss. A single armored route processes millions of dollars in physical cash and negotiable assets daily within a hyper-controlled environment where route predictability is intentionally randomized to prevent armed interception. Expanding on this macroeconomic reality, the history of secure logistics reveals an intense consolidation cycle where the capital cost of maintaining bulletproof vehicle fleets, global insurance syndicates, and regulatory compliance frameworks skyrocketed beyond the reach of regional competitors. As global financial transactions increasingly digitized, industry analysts prematurely predicted the complete extinction of physical cash and paper negotiable instruments. Instead, the paradoxical expansion of retail commerce and shadow banking created a massive, sustained demand for physical cash management, automated teller machine replenishment, and high-value precious metal transport. This high-stakes financial reality birthed the modern consolidated CIT model, separating routine freight shipping from ultra-secure asset transit and concentrating all global physical transport power into a tiny handful of elite security conglomerates. Governments and major commercial banks inadvertently surrendered operational self-sufficiency by outsourcing their cash handling and vault-to-vault transfers to these specialized private operators, creating an invisible structural backbone for the global economy. By anchoring the physical circulation of money to private corporate fleets, the entire retail and banking sector became tethered to the operational continuity of a few multinational security titans. The psychological and economic fallout of this concentration cannot be overstated, as every major bank branch, central bank clearinghouse, and retail giant depends entirely on this single industrial logistics bottleneck to function. As a result, modern commercial continuity is heavily dictated by secure transport efficiency, turning armored route optimization and vault logistics into the primary physical assets of the global financial system. The true financial engine driving the secure logistics monopoly is not traditional per-mile delivery freight rates, but a relentless economic feedback loop known as route density optimization and cash management outsourcing fees. Traditional freight shipping experiences linear cost reductions as delivery volume scales across broader geographic regions. Secure transport networks break this rule by mastering the economics of risk mitigation and route density, where clustering multiple high-value bank and retail pickups within a tight urban grid dramatically increases operational margins while diluting fixed armored vehicle overhead. Foundry-backed security operators eliminated standard competitive pricing pressure through absolute operational dominance, forcing commercial banks and retail chains to pay substantial recurring fees just to outsource their cash inventory liabilities. Customer enterprises commit multi-year service contracts to secure guaranteed armored pickup and ATM replenishment schedules, guaranteeing predictable, high-margin revenue streams before a single truck leaves the depot. Computerized route optimization systems track real-time traffic hazards, crime statistics, and cash inventory levels meticulously, allowing operators to dynamically adjust security parameters and maximize asset turnover per shift. This hyper-efficient logistics optimization ensures that mature urban operations generate staggering gross profit margins that dwarf traditional parcel delivery benchmarks. Furthermore, because establishing a rival armored transport network requires obtaining specialized regulatory licenses, multi-million-dollar insurance policies underwritten by syndicates like Lloyd's of London, and extensive ballistic vehicle fleets, high entry barriers allow incumbent monopolies to lock out independent competitors. Analyzing the mechanics of secure logistics economics exposes the profound structural friction that plagues logistics challengers attempting to break into the high-value transport market. When a well-funded traditional courier attempts to launch an armored transport service, they face a brutal risk and insurance liability dilemma. Insurers will not underwrite fleets that lack decades of verified tactical security data, and major banks will not entrust millions in physical cash to unproven operators. By maintaining absolute dominance over both the physical armored fleet and the underlying digital cash tracking software, the reigning security monopoly captures virtually all the economic surplus generated by physical commerce. This operational efficiency transforms raw cash transport into high-margin recurring service revenue that powers the cash flow stability of modern financial institutions. The economic genius of this model lies in its compounding route density. Every new retail client added to an existing urban delivery loop increases route profitability, widening the economic chasm against potential competitors. Consequently, private equity firms and institutional investors find themselves pouring unprecedented capital budgets into security fleet acquisitions, desperately trying to consolidate regional cash-handling operations. This structural asymmetry allows multi-billion-dollar security balance sheets to accumulate record-breaking cash reserves completely untethered from traditional cyclical retail downturns. The sheer scale of this physical-digital integration creates an unassailable competitive advantage, making it mathematically impossible for conventional courier corporations to replicate the security network's output. Beyond transporting physical cash, secure logistics networks function as indispensable financial liquidity and municipal settlement hubs for the global banking sector. Secure transport fleets have evolved into decentralized financial arteries and untraceable economic leverage instruments for central banks and commercial institutions. Asset owners and national monetary authorities use access to armored transport and ATM cash networks as high-octane operational leverage to regulate currency circulation and manage regional liquidity supplies. When a major commercial bank needs to rebalance cash reserves across hundreds of suburban branches or manage the massive currency distribution demands of the holiday shopping season, their entire retail solvency hinges on armored courier scheduling. In addition, secure transport networks generate substantial ancillary revenue through electronic vault storage, cash processing and sorting services, and end-to-end ATM hardware maintenance contracts. These ancillary financial services transform every armored depot into a high-margin cash flow generator that is completely immune to traditional consumer e-commerce slumps. This B2B logistics ecosystem operates entirely outside the visibility of everyday retail consumers, creating an autonomous financial transit market backed by ballistic steel and armed guards. Specialized cash processing centers maintain permanent automated sorting facilities directly adjacent to major regional transport hubs to evaluate currency authenticity, sort damaged bills, and mitigate cash handling risk instantaneously. When macro-environmental crises or banking panics trigger sudden surges in physical cash withdrawals, armored transport operators are called upon to execute emergency currency redistribution across the national banking grid. Furthermore, the ancillary infrastructure required to maintain these secure operations, such as biometric vault access terminals, encrypted satellite communication arrays, and secure dispatch command centers, demands astronomical capital investments. Security operators extract compounding economic rents from every single currency transaction, ensuring that even as digital payments expand, the foundational physical cash toll booth remains under their control. This transforms passive transport vans into active, high-yield economic utilities that extract a percentage of total global wealth with every passing fiscal quarter. The integration of automated cash recycling ATMs and AI-driven route security tracking has further streamlined this logistics empire, allowing instantaneous inventory reconciliation across multi-continental facility networks. Ultimately, this industrial machinery provides an unbreakable safety net for financial capital accumulation, ensuring that elite corporate fortunes and banking reserves remain liquid, secure, and entirely dependent on the secure transport monopoly. Deepening our exploration into this shadow economy of physical leverage, we find that access to enterprise-grade secure logistics functions as a modern form of macroeconomic stabilization. When geopolitical flashpoints or domestic civil unrest threaten public stability, intelligence agencies and central banks evaluate national security risks primarily through the lens of physical cash availability and retail supply continuity. A sudden disruption in armored transport networks can instantly paralyze local commerce, halting the functioning of retail, grocery stores, and gas stations within a matter of days. Consequently, sovereign states and central banks maintain close operational coordination with secure transport executives, treating CIT fleets as critical national infrastructure deserving of special regulatory protections. This corporate leverage allows transport monopolies to negotiate favorable municipal contracts and secure priority access during regional emergencies, shaping regional banking policies and physical security frameworks. Moreover, the ancillary ecosystem of specialized ballistic steel manufacturers, encrypted radio frequency hardware suppliers, and armed personnel training syndicates forms a dense web of interlocking global dependencies. If a single niche equipment supplier experiences a disruption, the entire armored vehicle manufacturing and maintenance pipeline can grind to an abrupt halt, demonstrating the radical fragility hidden beneath modern financial supremacy. This hyper-connected vulnerability ensures that leading-edge security providers remain at the epicenter of international monetary policy, corporate strategy, and global wealth preservation for the foreseeable future. Operating a global secure transport infrastructure across multi-jurisdictional urban territories requires maintaining strict corporate control over personnel vetting, vehicle engineering, and ballistic safety standards. The business model relies on a high-security management structure where facility operators enforce absolute operational confidentiality in exchange for providing ultra-reliable asset transit and advanced route scheduling software. However, shifting international regulatory scrutiny, driven by strict anti-money laundering regulations, occupational safety mandates, and complex firearms licensing laws, presents a massive compliance and operational hurdle. Complying with cross-border transport regulations and mandatory weapon tracking audits has become increasingly complex, forcing security operators to navigate treacherous legal waters. To maintain global distribution scale without violating local sovereign laws, corporate operators aggressively deploy diversified regional compliance strategies while managing state relationships through structured legal counseling. Behind the sleek architectural facades of modern cash processing depots lies an uncompromising tactical security apparatus designed to withstand armed heists, insider threats, and catastrophic facility breaches. Armored vehicles are insulated by multi-layered structural engineering, including B6/B7 ballistic steel plating, run-flat tire systems, electromagnetic tracking jammers, and continuous video monitoring arrays. Secure transport protocols operate with extreme precision, maintaining strict operational security parameters across every team dispatch to prevent ambush vulnerabilities and route predictability. To mitigate the existential threat of organized armed robberies or high-value highway attacks, facilities utilize tactical armed escort units and real-time satellite panic monitoring. Managing this labyrinth of physical and digital security requires an elite cadre of former military and law enforcement personnel who undergo rigorous background vetting and continuous tactical training. Despite these formidable security measures, the external operating environment has grown increasingly volatile as organized crime syndicates deploy sophisticated technology to target transport fleets. Operators must deftly navigate this shifting landscape by establishing resilient regional dispatch outposts and partnering closely with municipal law enforcement agencies. This high-stakes cat-and-mouse game between criminal elements and private security monopolies drives continuous innovation in corporate structuring, ensuring that the infrastructure remains resilient against physical and digital attacks. Looking further into the intricate operational challenges of running a hyperscale secure transport network, the labor and insurance requirement represents one of the most severe bottlenecks in the entire enterprise. Operating armed transport fleets and managing multi-billion-dollar cash vaults exposes companies to severe liability risks, often triggering astronomical insurance, premium hikes, and stringent underwriting demands. To secure uninterrupted operations, logistics operators must partner directly with elite global insurance syndicates to contract specialized risk policies, bypassing standard commercial insurers entirely. This heavy entanglement with international reinsurance markets transforms security operators into powerful macroeconomic stakeholders who dictate the risk pricing of physical cash management. Security protocols within these transport depots rival those of classified military installations, with strict digital air gapping, multi-factor biometric access controls, and comprehensive video surveillance designed to prevent internal collusion and theft. Every single cash bag and negotiable instrument is tracked through every step of the transport process via encrypted barcoding and automated optical scanning systems, ensuring complete chain of custody integrity. This uncompromising commitment to operational security guarantees that high-value assets remain protected against internal and external threats, preserving the massive commercial trust embedded within every armored delivery. To scale past domestic market saturation and labor cost pressures, major secure logistics empires execute aggressive international expansion strategies across emerging markets in Latin America, Africa, and Southeast Asia. By exporting their proprietary route optimization software, armored vehicle manufacturing blueprints, and cash processing automation protocols to newly acquired foreign subsidiaries, security operators capture massive global market share. Ultimately, owning the secure cash and asset transport ecosystem is not about driving armored trucks. It is about controlling the ultimate geopolitical microinfrastructure where global capital, retail commerce, and physical security intersect. As traditional metropolitan cash usage fluctuates alongside emerging digital payment trends, global capital inexorably flows toward permissive new jurisdictions backed by expanding cash-based informal economies and government-backed banking expansion. Emerging secure logistics corridors are actively constructing the next generation of automated cash sorting facilities, incorporating advanced robotic currency handling units and AI-driven predictive route security systems. By syndicating their proprietary operational know-how across these emerging international markets, legacy security providers protect their profit margins while insulating their banking customer portfolios from localized economic instability. This strategic globalization ensures that the monopoly on secure physical transport remains adaptable, heavily fortified, and permanently embedded at the center of the global economy. When viewed in its entirety, the secure logistics monopoly represents the ultimate triumph of tactical risk engineering over physical vulnerability, a sprawling, high-stakes empire of armored steel, encrypted data, and armed discipline. It guarantees that no matter how drastically digital payment technologies evolve or how aggressively fintech startups promote cashless societies, the foundational physical cash and asset mobility of the modern world will always rely on the masters of the armored transport ecosystem. The enduring power of this infrastructure proves that in the contemporary global economy, software is scalable, capital is fluid, and true financial supremacy ultimately belongs to those who control the physical vaults on wheels. Expanding on this grand concluding thesis, the ongoing evolution of secure logistics toward diversified global cash management networks marks a fundamental turning point in industrial history. While multinational corporations attempt to navigate changing consumer payment habits by integrating digital processing services, the underlying physical complexity and risk liability ensure that the core security moat remains firmly anchored to the parent enterprise ecosystem. Local cash processing hubs depend entirely on a continuous influx of specialized armored vehicles, encrypted tracking hardware, and proprietary auditing protocols originating from the central corporate headquarters. Consequently, geographical expansion and technological diversification do not dilute the monopoly. Rather, they expand its corporate footprint across multiple sovereign territories while locking commercial banks and central institutions into deep, long-term operational dependency. As global trade and retail cash demands drive exponential growth in secure transport volume, the strategic importance of enterprise-grade cash logistics will only intensify in the coming decades. Future generations of financial wealth and commercial stability will not be measured solely by digital ledgers, but by access to reliable physical transport architecture and the industrial capacity to safeguard it at scale. This immutable reality guarantees that the masters of the armored convoy will continue to dictate the economic and political destiny of human civilization, maintaining an unassailable chokehold over the physical flow of capital. Ultimately, the secure logistics network stands as the crowning achievement of modern risk management, an intricate billion-dollar temple of ballistic steel, encrypted telemetry, and armed vigilance that silently powers the entire trajectory of human commerce.